Welcome back to the best of Daybreak Middle East. New U.S. tariffs on roughly $110 billion of Chinese imports took effect this week, and China followed through with its own retaliatory measures. Even so, President Trump said trade talks in Washington would still go ahead.
We are talking to China. The meeting is still on. That hasn't changed. They haven't changed it. We haven't. We'll see what happens. But we can't allow China to rip us off anymore as a country. We can't allow China to take $500 billion a year out of our country. We can't do that.
Madison Tracy got more with our China correspondent Tom McKenzie and HG Research founder and CEO Hans Goethe.
You're looking now at $360 billion worth of Chinese imports into the US that are now facing or now have these tariffs on them. The latest round was 15% on $110 billion worth of goods, and that included things like textiles, it included things like shoes, but also tech products like the Apple Watch, for example. And then you're looking December the 15th at another round of tariffs from the US side, essentially covering off all Chinese imports into the US, so an additional 15% kicking in come December the 15th. And as you mentioned, we got retaliation from China as well, as they had flagged, hitting things like soybeans and oil and beef as well. And again, they're going to hit another round of US imports into the Chinese market come December the 15th. So you're talking about a significant ratcheting up. And of course, you've had the lobby groups, the business lobby groups in Washington saying, look, you've got to get back to talks. You've got to put in place a tariff truce, because this is really starting to hit corporates, but also US households as well. JP Morgan says that you could be looking at a hit to US households of about $1,000 a year if you do see tariffs on all Chinese imports into the US market.
Tom, the other aspect that we've got to take into consideration is the fixing, which was a little bit stronger again, balancing that on the currency against the data. And the data is beginning to look a little bit uneasy on the PMI readings.
Yeah, that's absolutely right. So we got the official PMI out over the weekend, and then the private survey at around 9:45 local time today. There's some divergence there. So the official numbers, you're right to say, you saw a fourth straight month of contraction for manufacturing PMI. In terms of the private survey, which focuses more on the SMEs and the private sector, you saw some surprise strength there. But Bloomberg Economics says don't get your hopes up. They expect further weakness in the months ahead, because they say that the business sentiment and the demand domestically is that much weaker than it was towards the beginning of this year. In terms of some bright spots, you saw non-manufacturing PMI rebound in the month of August, suggesting that maybe their services sector here is starting to accelerate. But again, most economists do think that policymakers are going to have to step up their support, whether that's more infrastructure spending or easing the curbs on the real estate market, or again, lowering those loan prime rates to ensure that there's cheaper credit to the private sector. That is where the focus is now, because the slowdown is pretty entrenched.
Yes, indeed. All right, our China correspondent, Tom McKenzie, thank you so much for that. Let's bring in HG Research founder and CEO Hans Goethe. He joins Manis and myself now from our Singapore studio. So good to see you this morning, Hans. Thank you for coming on the show, as always. I want to begin where... Thanks. I want to begin where Tom just left off, which is the economic impact of these trade tensions. What are you watching to gauge that impact in terms of either real economic activity or sentiment?
Well, sentiment clearly takes a hit. I mean, you can see it across the board. For instance, in the United States, you have a recession in capital spending. I mean, nobody is seriously thinking about the long term, and you have so much uncertainty surrounding the trade war. And unfortunately, there is no resolution in sight, because now whatever happens is heavily politicized. On one hand, you have the U.S. election in 2020, with President Trump wanting to get re-elected, obviously. He cannot appear to be weak. On the other hand, you have the 70th anniversary of the People's Republic of China. President Xi cannot appear to be weak, so I don't really see a resolution there. And I think the real problem is the hit to sentiment, and that basically slows down everything.
Yeah. It does indeed. I want to read you what the State Council said last night in response to this new escalation in tariffs. Reasonably ample liquidity, reasonable growth in aggregate financing as it implements prudent monetary policy with various risks, as they say, controllable overall. Would that be a fair assessment of the situation, or is that just perhaps a little bit misguided and you expect more substantial response?
I would expect a more substantial response. I mean, what we're looking at here is we're literally on the brink of a global recession. In the United States, it's probably the best-looking economy on a relative basis, but even there you see a slowdown, and you can foresee interest rates coming down even more. I mean, the Fed is going to cut in September. That's pretty much given, and also long-term Treasury yields are, in our view, going to decline further. What we have seen is actually a decline across the curve, and that is again a reflection of a recession in capital spending, low inflation, and essentially people trying to go to safe havens. The U.S. has a huge yield advantage versus everybody else. I think the U.S. is in yields is going to catch up on the downside with everybody else.
Hans, I wanted to bring up this chart. If you're a Bloomberg client, you can pull it up on the GTV function, of course. This is the standout trend for August, which was really a persistently strong dollar. So for instance, if you look at cross-asset performance, risk assets like stocks and commodities all took a hit. Meanwhile, safe havens like U.S. Treasuries and, of course, the dollar were up. Should we be worrying about a stubbornly strong dollar? Will there be some sort of U.S. intervention at some point?
That is a possibility, and in fact, it doesn't even. I mean, Trump could do it more or less by himself, working with the Treasury. I mean, what they could do is essentially buy yuan or whatever. So they could weaken the dollar if they wanted to, and I think that's a real risk here. Technically speaking, the dollar looks good, at least on the technical charts, and that is a reflection of the interest rate advantage that the United States has against the rest of the world. What is interesting to see, or has been interesting in August, is that precious metals, which usually go down and the dollar goes up, have actually gone up in lockstep with the dollar. That's a bit of a paradigm shift there, and clearly is an indication that investors are looking for safe havens, metals and treasuries included.
Hans, let's translate that across to what's happening in the equity market. We put it into the GTV library. This shows you the DAX, the Shanghai Comp, along with the S&P and Asian stocks. Now, the DAX and the Shanghai Comp had the first two negative back-to-back months of 2019. What needs to happen for you to perhaps scale in, buy the dip, to use some of the cliches in terms of the equity markets? For example, the ground zero for trade, the DAX and the Shanghai Comp.
Well, on one hand, you have deteriorating fundamentals. I mean, you have earnings growth coming down. That is a negative for equities. On the other hand, you have central banks, all of them easing, or at least intending to ease policy even more. So that would put the floor under equity prices. So we have these cross currents. On one hand, deteriorating fundamentals. On the other hand, the prospect of liquidity support. So we think that we have a good chance for an extended trading range in most equity markets, neither a crash nor a breakout on the upside. I think the way one should position itself would be to be in sectors which tend to do well during times of an economic slowdown, like consumer staples, like utilities, like real estate, investment trusts, and so on, and high dividend yield stocks. And I think then one could probably outperform the overall indexes. And I think cyclicals and anything that is sensitive to the economy will probably have to be underweight.
Well, on Thursday, China announced that its trade negotiators will travel to Washington early next month for talks with U.S. counterparts, boosting the chances for a resolution to the tariff war that caused global equity markets to rally. But how would the momentum play out across the Middle East? We asked Jaap Meijer, head of equity research at Arcam Capital.
We have had a lot of talks and actually nothing happening, and actually the rhetorics are only going to go worse and the tariffs only increased. Obviously it's positive that they're going back to the negotiation table. Obviously the markets will firm on the back of that. The read-through for the GCC is obviously one, oil demand. Obviously if the global growth slowdown is a bit less severe than we are expecting, obviously that's positive. For the petrochemicals, for example, it's the manufacturing sector that is quite important. So obviously manufacturing is taking a beating at the moment. If you look at the surveys, be it in Asia, be it in Europe, I think the outlook looks pretty dear. And obviously that has ramifications for the petchem sector, which is obviously a major component in Saudi.
Yep, it's Tracy Alloway in Hong Kong. It's good to see you again. I wanted to dig into some of the GCC equity story now, and particularly Saudi banks. We've been talking about their performance earlier in the year, doing very, very well, but it seems like they are starting to lose some momentum. And with SIBOR rates actually falling, you would expect net margins to start to get compressed. What's your outlook for Saudi banks from here?
Yeah, pretty gloomy indeed. So we had obviously the first rate cut going to filter through in the third quarter, but the sensitivity to the Saudi banks is very large to lower rates. That's a reflection of, let's say, a high share of the assets being repriced immediately or with a 3-month delay, whilst at the same time they enjoy very low funding costs, but it's very low capacity to kind of reduce this when rates go lower. So the impact is quite severe. Every 25 basis points is 3% impact immediately following the year thereafter. And over time, every 25 basis points is a 1% reduction or more on their return on equity. So it's extremely sensitive. Some of the valuations are still very high. Just looking at Al Rajhi, for example, still at 3 times book. So obviously we do see some further downside from current levels. That is also applicable for the rest of the Saudi index. I mean, we've seen the Saudi index drifting sharply lower after the second phase of MECI. The outlook for Petchem is quite gloomy as well. I think consensus estimates will have to come down even more. The two major components in the telco industry are extremely overvalued, and we see another 5 to 10% down leg in the Saudi banks.
Up next, failure to launch as Gulf economies stumble. Bloomberg sources say work on Dubai's Al Maktoum mega airport has been halted. This is Bloomberg.